All right, let's just throw the financial rulebook out the window because what's happening right now, it makes no sense. We've got oil prices absolutely blasting past $100 a barrel. A critical global shipping lane is shut down. And yet gold, the world's ultimate safe haven, is falling. So today we're going to decode this whole paradox. We're going to figure out what is going on and show you exactly where the smart money is actually flowing.
So just look at the pieces on the board. You've got Brent crude just rocketing past that $100 mark because a major conflict has shut down a vital shipping lane. But then you look over at gold, the asset you're supposed to own in a crisis, and it's actually struggling. Now, this isn't some kind of glitch in the matrix. This contradiction is the key. It's the single most important piece of the puzzle to understanding everything that's happening in the market today.
Okay, so how did we even get here? What kicked this whole thing off? Well, it all goes back to a sudden, really dramatic geopolitical event that sent a massive shockwave right through the global energy supply. And you just have to appreciate how fast this all went down. Look at the timeline. February 28th, strikes hit Iran. That same day, instantly, tanker traffic in the Strait of Hormuz just flatlines. It goes to zero. Only 2 days later, Iran retaliates, and boom, oil surges 10%. By March 8th, we're talking less than 2 weeks from the initial event, we've already blown past that critical $100 a barrel mark. The panic got so bad that the IEA had to step in and announce this historic 400 million barrel strategic release, just trying to calm things down.
And to really get why this is such a huge deal, you just have to look at the map. The Strait of Hormuz, it's not just some waterway, it is the artery. We're talking about almost 20% of the entire world's daily oil supply passing through this one tiny choke point. So when you shut that down, it's like taking a pair of pliers and clamping shut the fuel line to the entire global economy.
And the numbers. Wow, the numbers really tell the story here. Just look at this. These are not minor blips on a screen. Brent crude didn't just, inch up. It nearly doubled. It skyrocketed from around $66 to $126. At the same time, European natural gas jumps 50%. This isn't market noise, folks. This is a full-blown economic explosion.
So you have this massive energy crisis. And what it does is it immediately creates an absolute worst-case scenario for the global economy. Seriously, this is the stuff that central bankers have nightmares about.
And that nightmare, yeah, it's got a name, stagflation. And it is a truly toxic economic cocktail. It's where economic growth just grinds to a halt or even goes backward. But at the same time, prices just keep going up and up. So you get all the pain of a recession plus all the pain of inflation. It's the worst of both worlds, and it is notoriously difficult to fight.
And don't just take my word for it. The experts are crystal clear about what's at stake here. Bob McNally, who used to be the White House energy advisor, put it perfectly. He said a prolonged closure of the strait isn't a risk of a global recession, it's a flat-out guarantee. So that begs the question, how did the most powerful central bank on the planet, the US Federal Reserve, react to all this? Well, simply put, they took their entire playbook for 2026 and they just ripped it to shreds.
And here's the result. The federal funds rate is now frozen solid, 3.75% on hold. You have to remember, the market was fully expecting a whole series of rate cuts this year. That entire story, that whole narrative has been completely wiped off the table, just gone, almost overnight.
What's happened is the Fed has been completely boxed in. They're trapped. On one side, you've got this surge in energy prices that's pouring gasoline on the fire of inflation. That forces them to keep rates high. But keeping rates high slams the brakes on an economy that's already sputtering because of those very same high energy costs. They're stuck. They can't cut rates to help the economy because that would just make inflation spiral even further out of control.
And that brings us really to the most confusing, the most counterintuitive part of this entire story. In a world with war, with inflation surging, why on earth is the ultimate safe haven asset, gold, behaving so strangely?
Seriously, this is the question every single trader is asking themselves right now. We have war, we have out-of-control energy inflation, we have extreme, massive uncertainty. If you look at any history book, gold should be absolutely exploding to new all-time highs. But it's not. So why? What is going on?
Well, the culprit is the world's other safe haven, the US dollar. See, when there's a global panic, what does big money do? It floods into the perceived safety of US government debt. And to buy that debt, you have to buy US dollars first. This massive rush into the dollar makes it incredibly strong.
And a stronger dollar? Well, it acts like a giant anchor on the price of gold, because gold is priced in dollars.
But, and you have to catch this nuance, it's critical, the price isn't totally collapsing either. There is a very powerful floor under the gold market right now, and who's building that floor? It's emerging market central banks. They've been buying gold at an absolutely record-breaking pace precisely because they want to diversify away from the US dollar. So what you're seeing is a battle of titans. You've got institutional investors rushing into the dollar, and you've got central banks rushing into gold.
Okay, so we've got this incredibly complex battle playing out between the dollar and central banks. So the question is, how are the big players, the hedge funds, the institutions, how are they actually positioning their money? Well, that takes us right into the institutional playbook.
And right now, the market is completely split. It's basically defined by two totally competing stories. On one side, you've got the bulls. They're playing pure defense, just trying to preserve their capital. Then on the other side, you've got the bears, and they believe this whole energy shock is the final trigger for a deep, painful global recession.
Let's break down the bull case. It's really simple. It's all about safety first. They're buying up short-term US Treasuries to get that safe yield. They're loading up on defense stocks, which obviously benefit from more global conflict. And of course, they're buying energy stocks that profit directly from higher oil prices. It's a classic defensive crouch, just designed to ride out the storm. Now, the bears, they see a completely different movie playing out. Their argument is that oil staying above $100 is it's not sustainable. It's going to crush corporate profit margins, which will inevitably lead to a global slowdown. And that slowdown is going to destroy demand for energy, which, ironically, will cause the price of oil to eventually crash. So, they are staying far, far away from anything sensitive to economic growth, especially high-growth tech stocks.
So there you have it, two powerful opposing ideas fighting for control of the entire market. So the critical question for us is, what are the key signals? What do we need to be watching to see which side is actually winning this fight?
Okay, so here's your dashboard. These are the things to watch for the rest of this quarter. First and foremost, the status of the Strait of Hormuz. Any sign of it reopening is a huge de-escalation signal. Second, that $100 line in the sand for oil. Does Brent crude stay above it or fall below it? If it stays above, the recession argument gets a lot stronger. Third, watch the US dollar index, the DXY. As long as that's climbing, it's going to be tough for gold. And finally, maybe the most important of all, keep your eyes glued to core inflation data and bond yields. These are the indicators that will tell us if this energy shock is staying contained or if it's starting to bleed into the rest of the economy and really forcing the Fed into a corner.
And all of that leaves us with one final, massive question. Right now, the market seems to be pricing this in as a short-term shock, a temporary crisis that'll eventually resolve itself. But what if the market is wrong? What if this isn't just another crisis we'll get through? What if this is the start of something new, a new economic era? What if this is the return of the 1970s, the dawn of stagflation 2.0?